Okay, greetings everyone. The purpose of this video is I would like to answer some of those tutorial questions in a bit more detail. Now, I have a confession to make, which is that I made this video the first time and then discovered to my horror that the microphone wasn't working. So I'm now having to do the voice over a second time. So if there's any lag between what you see on the screen and what I'm saying, there's a reason for that, and I do apologize. It is not because I'm drunk, it's because I am trying to make a commentary as we go along while the screen is playing in front of me. It's a little bit like those DVD director's cut, where they make the movie first and then they do a commentary. Okay, now what's happening is, first of all, I like to have a go at the question regarding Schiller's feedback model. And so this student wrote in and she's asking, in the feedback model, the price of time t is determined by two parts. For the second part, which are its lag changes, I'm quite confused. First, why do we call it lag changes? And then second, in the example Dr. Fong, it should be Professor Fong gave us, why are we discounting price changes all the way back to 1871 as a part of 1980's real price, when the today is supposed to be 1980. Now let's take a look first at this equation number 1, which is no, not this one. This is actually from Farmer's paper, which I'm going to be talking about a little bit later. So what I need is the equation from Schiller's paper. Okay, now this is equation 1 from the Schiller's paper on the as a price feedback model, so to speak. Now when you look at equation 1, what you see here is PT, the price of, let's say, a stock. It can be any asset, but let's say a stock at any moment in time should be equal to pi t, which is its fundamental or its true or its fair value, so to speak, plus the price changes between now and time in the past. So you can go back like 100 years, and if you were to do this on a daily basis, so every year there are 250 trading days, so over 100 years you're talking like 25,000 observations, and then you basically sum them all up and you take an average, and you now these are that's why we call them lag changes. Lag just means looking at it from the point of view of today. So yesterday, the price change from yesterday is a lag change, or 2 days before, or 3 days before, or 10 years ago. So these are lag changes, and you will look at the change from 10 year, 20 year, 50, even 100 years, okay, and then you just add them all up after you discount them and you take an average. And the point here is that when you look at the formula, there's a discounting t minus tau. Okay, so t is today. Think of t as being today, and so the further back you go, and tau is whatever the time was that you started. so it will be it's not minus infinity, but it's like 1871, which is like 140 years ago. And then the further back you go, the more you'll be discounting it. And I think this is quite a cool formula, because normally we discount cash flows, as we've always been taught, like in the bond market, we discount future cash flows. But here we're discounting price changes from the past, back to the present, and then the further back you go, the deeper discount will be applied. So this is quite a clever formula, I thought. So it starts at 1871 and goes all the way back to the present day, if you want to. Okay, and then the little t actually equals 1980. Now, the pi t is supposed to be the true, or the fair value, and then those dp tau, they are the price changes. So what we are saying here is that if stock prices are at any moment in time simply equal to its true fundamental fair value, whatever you want to call it, then that little c, that coefficient, really should be equal to 0, because you're trying to apply all those dp1, dp2, dp3. If they have no part to play in this equation, then you'd find that when you force them to be in the same room, then c would be equal to 0, in order to silence any impact you might get from the dp tau's. Okay, so that's the equation there. Okay, so it really is just trying to speculate, if you like, on whether stock prices do follow just their fundamental value, or is there something else which is there, which is driven by past changes of prices. That's it. Okay, if that was the case, then you would find that c is significantly different from 0. And I think empirically, if you look at what happens in the real world, it is to a great extent quite true. So the graph that you see in front of you, for example, let's just say that the black line is the fair value, and then the blue line is the actual price movement of a particular stock. So let's say they do actually start at the same value. So what we tend to find is that as you get price increase one after another, then the in the fundamental value, in the fair value, okay, as you get price increases there, then the real price tends to go up even more, because it goes up because of the increase in fundamental price, but it also goes up because of the feedback from price changes, which is the area between the blue and the black line. Okay, so that sort of accumulates, dp1, dp2, dp3, and then if these are all positive, then the feedback continues, and people get more and more excited on the way up, and they bid up stock prices, and then when it comes back down, when the dp1, dp4, dp5, dp6, when they are negative, then you go the other way, and then of course the dp 1, 2, 3 are still there, the positive value, but their effect will diminish because of the discounting, and they are in the distant past. And then when the negative values start to dominate, you have a market that starts to sort of undershoot, if you like, and it goes to the other extreme. That, I think that is a fairly accurate representation of reality. Whether you agree with this model or not, we do see that quite often. So in that respect, I think there is some value in this theory. Now, so this question was actually answered in some of the tutorials, but not all of them. So, which is another reason I'm making this video here. There is actually another question related to this, which I have not answered to anyone. Okay, which I am doing now, and I thought that was a pretty good question as well. You may want to pause the video and have a look at this question. So this student is actually just asking what is going on here with the rest of those equations that you find in the Schiller paper. Now, my first reaction to this is I strongly recommend that you don't worry too much about this. Okay, first of all, I think it's not really necessary. It's not within the scope of this course. But if you really want to know, I do want to do what I can to satisfy your intellectual curiosity. Okay, so I'm going to do that now. And now, if you just scroll down a little bit, you see a couple more equations from the Schiller paper. So equation number 2, what you've got is it says Pt is equal to pi t plus little c divided by 1 minus c, and then multiplied by pi t minus pi t bar. And some of you might be wondering, well, what the heck is going on here? Okay, and you got equation 3 down there, where pi t bar is equal to an integral over time, okay, of price changes. Now, what is pi t bar? Pi t bar is just a weighted average of all the previous values of pi t. Okay, so all the fundamental value changes that you saw in the past. Now, I can actually give you a simple example and to tie all this stuff together, and especially to try to derive for you, where did equation 2 come from? Okay, and what I like to do is now first you just imagine that you have a certain stock, and the stock started at a price of $10. Now, when I say started, I'm saying that is the fundamental value, okay, for that stock at the beginning, and then the fundamental value or the fair value, if you like, okay, started at 10, went up to 12, went up to 15, and then went up to 18. Okay, now this is pi t in period 1, period 2, 3, and 4. Okay, so it starts at 10 now and ends up at 18. If you take the average of 10 and 12 and 15, okay, so you are taking the average of the pi t. Now this is the pi t bar that you saw in the paper. Okay, now what's that equal to? That should be $12 and 33 cents. Okay, $12.33. Now this is the so-called, so pi 4. If you want to work out pi 4 minus the pi t bar of all the values before, that is simply 18 minus 12 and 1/3. Okay, I keep writing 2/3 there. That was wrong. I'm going to rub it off in a moment. Okay, see, I can tell the future now. So anyway, so that should be equal to 5 2/3. Okay, so 5.66. Now you can look at this in another way. So you draw a line, and you know that the price, the fundamental price, started at 10, or the fair value. Okay, it goes up to 12, 15, and then 18. So what if I take a look at the fair value now, which is 18, okay, and I take the difference between that and the starting fair value, so I have a difference of $8, okay. I then compare it to the next period, so there's a price jump of $6, and then from the last period to this period there's a price jump of $3. 18 minus 15. Okay, this is just another way of looking at things. Okay, now what if you take these price jumps, you add them up, and then you average them out. Okay, so 8 plus 6 plus 3 is equal to 17. Okay, and then if you divide 17 by 3, you're going to get $5 and 2/3 dollars, or $5.66. When I did the first take of this video, this is the point when I realized I made a writing mistake on the other side. So that should be $12.33 was the average. So that's pi t bar. 18 minus 12.33 is 5.66. So all I'm saying here is, when you take the current fair value, pi 4, and then subtract the average of the previous fair values, that should be equal to the average of the price jumps on the right hand side. Now this is a very, very simple representation, and the reason I'm doing this is I now go to the calculus equivalent, and the equation given by Schiller, okay, is a far more sophisticated representation, but it essentially is the same idea that I have just presented to you. Okay, and what was that equation? Okay, now you have pi t bar, pi t minus pi t bar is equal to the discounted value, or the average discounted value of all the price jumps. Okay, now this is the, like I said, mathematical equivalent of what I just showed you up there. Now don't get too hung up, don't get too worried about this. Okay, I don't really want to enter into any further, theoretical discussions about this or that, but just listen to what I said. Okay, so on the left hand side, the pi t minus pi t bar should be equal to the average discounted price jumps, and that would be the equation for that statement I just made. Now, that being the case, what we are saying is, if stock prices are always behaving as though they just follow the fair value and nothing else, let's say, okay, so then the right hand side of the equation completely explains the left hand side. But what if it is not able to explain it completely? What if it just explains like 70%, So you've got the left hand side is equal to 0.7 multiplied by that integral. So in other words, if I put 1 minus c there, and I find there's a meaningful value for c, okay, so let's say in this case c was 0.3, and then the left hand side does not explain the right hand side entirely, okay. What if there is some value of c out there, okay? Now you see what I'm getting at in a moment, because if that was the case, if there really is a little c that we should think about, then you just take that 1 minus c to the other side. So pi t minus pi t bar divided by 1 minus c is equal to the integral on the right hand side. Okay, so e minus lambda t minus tau dp tau. Okay, and when you have that, you can actually do a little bit more algebraic manipulation, and remember the original formula given by Schiller in his model construct was that the price t should be equal to pi t, the fair value at time t, plus c multiplied by that integral. Now you see that that integral, now this is equation 1 I've just written, okay. You can call the above equation 0 if you like, okay. So you can substitute back the left hand side of equation 0 into equation 1, and you get pt is equal to pi t plus c multiplied by that integral. You take that away and you put is equal to c times pi t minus pi t bar divided by 1 minus c. Okay. Now once you do that, then all you got to do is you multiply everything out, and then you soon realize when you do that you have pi t times 1 minus c, the denominator, plus c times pi t minus pi t bar. Now there's nothing tricky here. This is literally just high school algebra, and then you multiply it out, and you take it one step further, and that becomes pi t minus c pi t plus c pi t minus c pi t bar, okay, divided by 1 minus c. Okay. Now you should see that the c pi t and c pi t bar will cancel each other, so you get rid of that, okay, and what you are left with is pi t divided by 1 minus c, and then minus c pi t bar divided by 1 minus c. Now this is the equation that was given by Schiller. This I think was equation number 2. So I am here just explaining to you where it came from by relating to you a very, very simple example of connecting, fundamental or fair values to the average of price jumps. Remember, that's how I started this example. Okay, now, like I said, please do not get too obsessed. I'm really doing this for your entertainment and for satisfying your intellectual curiosity, which I love doing. Okay, but do not spend time torturing yourself and going to the end of time, and don't torture yourself at 2:30 in the morning trying to figure out any further. This is enough. Okay, so I hope this is helpful. Okay, so I'll just try to relate fair values and price jumps and the integral for the discounted average with pi t minus pi t bar, and then I just basically reversed engineer back the equation number 2, okay, from Schiller. Now, let me tackle this is question 2. This is regarding Farmer's paper, okay, and so the question starts, I don't understand the relationship between fair game and random walk. In my opinion, fair game means no one can earn abnormal return, and then there's reference to the formula in Farmer's paper. Do I understand it correctly that people get the same return when they have the same information? And what is the internal meaning? Random walk is a special case for fair games. Now, there are 3 questions here, I think. So one is, what is fair game, first of all, and second, what's going on with that equation in Farmer's paper, number 2, and number 3, what does it mean random walk is a special case of fair game? Now let's tackle these one by one. Okay. I'm waiting for the screen to turn. I think to understand fair game, a fair game is simply, okay, first of all, when you play a game, it takes 2 persons, okay, you and me. Now, if we play a game, the best example is probably tossing a coin. So you throw a coin, and let's say you choose head or tail or whatever, okay, and when you win, you make $1 from me, and when you lose, you give me $1. Okay, now that kind of a game would be a fair game because neither party, neither you nor me, is actually at an advantage over the other person, so it's completely fair. And mathematically, what that means is the expected payoff of this game that we play, if we were to play 1,000,000 times, the expected payoff would be exactly 0. Okay. Now, imagine if there's another game where there's something wrong with the coin and it has a 60% chance of getting a head and a 40% chance of getting tail. Okay, and let's say if head comes up, you will lose $1, and if tail comes up, you're gonna win $1. Now, this game, in this case, is not a fair game anymore. It's not fair to you because your expected losses will be 60 cents for every game, whereas your expected winnings are only 40 cents. Okay, so you have a expected negative outcome. So the expected outcome is not 0. So this game is not fair. Okay, now statistically, this is how you would define a fair game. But let's take a look at another game. Now the coin is the same coin, but this time, if it goes up, not goes up. If it's head, you lose 40 cents, but if it's tail, you win 60 cents. Now this game is fair because no matter what happens, the expected loss would be 24 cents, whereas the expected gain is also 24 cents. Okay, so although the probabilities are different, a fair game just means when you multiply the probability of win together with the amount you win, it's equal to the probability of loss multiplied by the loss amount. Okay, so in other words, your expectations are the same. Now, in a random market, a random walk, what we say is that first of all, it's 50-50. You got no clue where it will go, and then it has the equal chance of making or losing $1. In this case, this is a random walk. Now, not only is this random walk, is this a fair game? Of course it is. Okay, you just multiply 50% by -1. That's your loss, expected loss, and then multiply 50% by +1. That's your expected gain. What is your overall expectation? 0. Okay, so the difference between random walk and fair game is that a random walk, the up-down movements are equally likely. Okay, so you could say that a random walk is always a fair game, but there are a lot of different types of fair games. Okay, like the two that I described to you just now. Okay, now if you have a look at Farmer's paper, now this equation actually is a lot simpler than you think. All it's saying, and this is I think sometimes you can understand the sheer elegance of mathematics. Mathematics, in the end, what is it? It is just a language, just like anything else, and it very precisely and elegantly summarizes, some complex relationships that would take me 3 minutes to explain to you, instead of just one simple line that you now see in front of you. So what we're saying here is the expected price of stock J in the next period, given what you know now, that's phi t, that's the information set, should be equal to 1 plus the expected return for that stock, given what you know now, multiplied by the price now. This isn't just another way of saying, okay, given what we know, phi t, and given the price, pjt now, okay, if we have an expected return, then everything is priced in and you can't make any extra profit. Now, the issue here, of course, is what the hell is rj t plus 1? What should be the return of the next period? Now, that's $1 million question. Now, we actually will talk a bit more about this a little later on in this course. I guess in a way this course is about estimate. After all, it is about estimating the return. But let's just say we know, okay, then the efficient market says, all right, it's all priced in, and everyone has the same information, and if we agree on what the expected return should be, then there should not be any argument on the price. Okay, so that's what that is saying. And of course, this actually would open up another theoretical discussion on, how you can estimate the expected return and so on. Okay. Now, I think I've already kind of answered the last part of this question, which is why is a random walk, a special case of a fair game, okay, because it has a zero expectation, which is what all fair games do. Now, let me take a look at this one. This question here it concerns the difference between unit trust and a mutual fund, first of all, and what the difference between an open-end and closed-end fund. My first response to you is, do not worry too much. This is largely a question of legality. If you invest in a mutual fund, so let's say Fidelity, emerging market growth fund, whatever, okay. If you invest in a mutual fund, you give money to that company or to that fund vehicle, and you are a shareholder of that fund, which is kind of a limited company, and then so you are the owner, you are the boss, and you employ the fund managers to act on your behalf. Now, if you invest in unit trusts, what is a unit trust? It's a different legal structure where you would put your money in a trust, and there is a trustee who has a duty, and CFA is very fond of saying this, a fiduciary duty to look after your assets and act upon your instructions. And one of your instructions might be, okay, I appoint, Mr. So-and-so from Templeton Asset Management to be the manager for my assets here, for example. Okay, and then the trustee is responsible for executing your instruction, not portfolio management, just executing your instructions. Hire the manager, put the assets in a safe place, look after the coupons, look after the dividends, pay them to the right account, all that kind of stuff. Okay, a trustee would be doing that. If you are really interested, there's actually a web page from Hong Kong Exchange, which gives you a little bit more detail. I don't think you really need to worry too much about it, as I said. But if you want to know, I guess the info is there, and you can read up. Now this page is actually fairly useful. It's not really that long, but it does tell you the difference between a unit trust and a mutual fund. So as I said, it's really just a question of legal difference. There are other, taxation implications to it. Okay, but don't worry too much about that. Now the other part is asking about the difference between an open-end and a closed-end fund. I would say the difference is if a fund is open-ended, then if I started with let's say $100 million portfolio, and if somebody gives me more money, which is always a good thing, so if someone gives me another $2 million, let's say, then I would take that, and my fund becomes $102 million. Whereas if it's a closed-end fund, then after I've taken the money, if you really want to be a subscriber, you would have to go to somebody who wants to sell to you. Okay. Now, generally, I would say that almost all hedge funds are closed-end funds. So after they take your money, they would not welcome any buy or sell into the fund itself. They don't welcome any change in the fund size. I think a key reason is that many hedge funds are actually involved with buying or selling investment products or assets that are not very liquid, and they need time. So what they would do is they would take your money, and once they have it, they invest in those strategies, and they definitely prefer not to be disturbed. So if you give them $10 million today, and then the day after you say you want to withdraw $4 million, and then their strategy hasn't even had time to work, and for them to sell those illiquid assets, sometimes it can be quite hard. So I would say all the hedge funds are of a closed form nature. Okay. Now, I hope that's been helpful. So like I said, when you guys ask questions, I love to hear from you, and I like to answer them well. If I can't do it in a tutorial, I will use an alternate format, which is what we're doing here. Okay, hope that was helpful. Thank you. Bye-bye. Take care.